These webinars were prompted by a report just released by Sea Action about accessing secondary markets for energy efficiency. We're about to post a link to this in the GoToMeeting chat window, and I'd really encourage all of our listeners to go and check it out to learn more about the role that secondary markets can and have had in growing the energy efficiency market. Today's presentation is being brought to you by the team for the Yale Center for Business and the Environment's Blueprint for Efficiency, which is in its 6th year of providing public webinars emphasizing the latest trends and opportunities for energy efficiency. Each presentation is recorded and available through the Yale Center for Business and the Environment website and the Blueprint for Efficiency iTunes U page. A link to download the slides from today's presentation has also been posted in the chat window. We're delighted to welcome today's presenters. Firstly, Adam Zimmerman from Craft 3, along with Alison Moy from Self-Help Credit Union, will be co-presenting the Craft 3 Self-Help Deal. Next, Bert Hunter from the Connecticut Green Bank will be presenting Connecticut's CPACE program. And finally, we have John Byrne from the University of Delaware, who will be presenting Delaware's Sustainable Electric Utility Program. Before we begin, I have the pleasure of introducing Bruce Schlein, Director of Corporate Sustainability at Citi and co-chair of the Sea Action Financing Solutions Working Group, to provide an overview of the work that Sea Action is doing around the country to encourage investment in energy efficiency. Finally, I'd like to remind listeners that we welcome any questions, and we'll be providing plenty of time to put those questions to the speakers at the end of this presentation. So please put any questions that you do have into the GoToMeeting chat window. And with that, I'll hand it over to Bruce.
Well, great. Thank you very much, Michael. And thanks to our colleagues and friends at Yale for hosting this webinar. I'm going to take a minute or two just to introduce Sea Action, which I think many of you know or participate in some capacity. Sea Action is a network facilitated by the Department of Energy and the US EPA of at least a couple hundred leaders and professionals working to bring energy efficiency to scale. You can see there are 8 groups that comprise Sea Action. The one that worked on and helped advise on the paper that Michael referred to, and that there will be case studies discussed today, is the Financing Solutions Working Group. You can see on the slide that describes that working group the key barriers that we're working to tackle, and the focus areas are also described there with respect to data access, program design, financing tools, and the regulatory treatment of financing. The working group, I'm fortunate to be co-chairing together with my colleague Brian Garcia of the Connecticut Green Bank, with great facilitation from US DOE's Johanna Zetterberg and the US EPA's Brian Ng. And you can see there on the right-hand side of this slide, we've got a great group of colleagues that are working together with us in this working group. And then, of course, exceptional support and advice from the Lawrence Berkeley National Lab. What I'll do now is turn the webinar over to our colleagues at Craft 3 and Self-Help, Adam Zimmerman and Alison Moy, and thank them and everyone who helped put this together. Thanks.
Good morning, everybody. This is Adam Zimmerman at Craft 3. Allison and I will be telling you a little bit about the transaction that we put together, mostly over the course of now 2013, and closed at the very end of the year. So I'm Adam. I'm out in Portland, Oregon. You can go to the next slide. Our organization is called Craft 3. We're what's known in some circles as a community development finance institution. And we're a charity. We're a nonprofit. We're a C3. for those curious, the CDFI label comes from the U.S. Treasury Department. There's a department within Treasury that provides support for organizations like ours in self-help. We're 20 years old last year, and we serve Oregon and Washington. We have about 8 offices across 2 states. And our mission is very much about investing in what used to be called the triple bottom line, but we look to make impacts on the economic, ecological, and family resilience in the communities that we work in. Next slide.
Thanks, Adam. So this is Allison Moy from Self-Help. I'm in the commercial lending department here in our headquarters in Durham, North Carolina. Similar to Craft 3, we are a CDFI as well. We look a little bit different from Craft 3 in that we focus nationally, but hone in on North Carolina, California, DC Metro, and Chicago areas. We're slightly more complex in terms of the number of organizations that we have under our CDFI umbrella. We include 2 different credit unions, one that's state chartered, another that's federally, a nonprofit ventures fund, as well as a nonprofit advocacy arm that works to combat predatory financial practices across the nation. We've been working amongst these different entities for about 30 years with the mission of focusing on creating economic opportunity through access to credit for low and moderate income communities. Since our inception, we've originated about $6.4 billion in loans. That includes anything from a home loan to a lower moderate income family, as well as commercial real estate loans that support the same communities. In the last 5 years, we've been trying to put a particular emphasis on our green lending sector, and this purchase with Craft 3 definitely falls within that for us. But in the green lending sector alone, in the last 5 years, we've originated about $140 million to facilities that employ energy efficient measures and have invested about $76 million specifically to renewable energy producers of varying sizes, but mostly in the solar arena. So I'll turn it back over to Adam, next slide, to talk about Craft 3's particular program.
Thanks, Allison. And I'll go off script a bit and just say that Self-Help is a incredibly well-respected organization within our field of community development finance. I think Allison's being modest. They are a role model, and I kind of think of them as the granddaddy of CDFIs and those who are always testing new opportunities. So when she says they're a bit more complex than we are, they're way more complex than we are. But that was great. And so the next few slides are designed to give you all a sense of why we built the portfolio and then why we sold it. So I will make 2 points first, which is, as I mentioned earlier, we're a mission-based nonprofit that does a number of different financial transactions, types of financial transactions. And when we look at the kind of transactions we're going to do, we're focused on what makes our communities more resilient. And we very much looked at the energy efficiency space as a way to reduce overhead for businesses and homeowners in the areas that we're working. And then the other piece is to create opportunity for, frankly, construction trades. And I know it may seem like distant history to some of us now, but when we started doing this lending in 2009, we were at the cusp of the recession, frankly, or starting to wade deeper into it. So we were very much focused on how to turn energy efficiency retrofits into an opportunity for small to medium-sized contractors in our markets to put people to work. And so we call that the opportunity climate economy, the opportunity piece being ways for people to build skills and have a living wage. Next slide. So this is the basics on our loan product. I think I already mentioned we're after jobs. We're also after reduced carbon impact. Our 2 states are incredibly focused on finding ways to reduce the greenhouse gas impact of our region of the country. And then we're after what we call inclusive credit. So that means allowing folks with lower credit scores into the portfolio. We use on-bill repayment both as a method of repayment but also as a method of underwriting. So we look at people's credits, we look at their credit scores and their utility bill payment histories to construct a credit profile. And then we have developed a way of shuttling information back and forth on people's payments with the utilities that we work with. The product specifications for the portfolio that we sold to self-help, in large part, the rate was right around 6%. We started with longer terms, up to 20 years, and reduced them to 15. I will say about that in Oregon and Washington we have a mild climate and low energy costs. So in order to push the loan payments toward the monthly savings or on an annualized basis the monthly savings, we really needed to stretch out the amortization schedule. And that's important to note because self-help was willing to take a look at assets that were stretched out that long. We file a UCC on all of our loans. We were in the past filing what was in general a secondary deed of trust. That became evident actually through our work with self-help that was not a terribly important piece of the underwrite and the asset quality. And we can certainly talk more about that if people are curious. And then the servicing is done through the utility that provides the heat. We have a loan loss reserve that we have built up that's available for losses, and that we look for project types that really minimize the cash flow impact. Next slide, please. So we work with utilities almost exclusively. We've got about 3% of our loans that are off-bill, and those are folks who originated on-bill and then fell off in some cases because they got in a tiff with their utility company, not because they were a bad credit, and that just happens. We're looking for ways that we can offer inclusive credit, and I'll say just a little bit more about this. When we do a credit screening, we first look at the utility payment history, and we're really looking for folks who are paying relatively regularly over the course of a 12-month period. And we have a little matrix that uses credit score, uses a couple other items, and then looks at payment history. And we score each of those items, and if they come in below a certain score, I think it's 4 now, we approve someone, and that means that they could have a credit score as low as 590, but if they're paying their bill regularly, we will make them a loan. And I think in general, I mean, on bill is a long topic. Customers, we find our customers very much like it. They stay with us, performance has been good, and we think that it reduces the risk to the portfolio across the board. But we're only 5 years in now, and I think that there's an opportunity to build data on how on-bill supports portfolio performance. Next slide. These are the 4 utilities that we work with. The 3 involved in the transaction with self-help were Northwest Natural, Pacific Power, and Portland General Electric. Next slide, please. This is a bit about on-bill, if you're curious. I think that one of the important things here is that we do not have shut-off power. My opinion is that that doesn't give us a lot of leverage in terms of turning a marginally performing loan into a performing loan. By the time someone slides to the point where they might be able to have shut-off power, I don't think they're recoverable as an asset. in all of these relationships, the utility retains payment priority, which basically means they get their money first, what is owed to them. They'll only, the utilities will only collect a payment once a month, and then they remit that to us, to Craft 3, once a month. And in the case of our relationship with Self-Help, we're performing the servicing role, and we collect the money from the utilities, we bulk it up, and we send it over to Self-Help with a reconciliation reporting on a monthly basis. Next slide. So I think I've hit most of these in terms of inclusive credit. I think simplifying loan options for customers is really an important piece. I think that a way for on-bill presents a way for customers to pay easily and quickly. Our role, certainly in our interaction with Self-Help, is to present essentially a servicing mechanism for on-bill and push the funds to the secondary owner. And I think that's an interesting and possibly something that could be expanded. Craft 3 as an organization, we don't have a brand dog in the fight. We're not concerned that people see our brand and want to buy other things from us. And I think in some cases, investors don't really, as long as the asset quality is there, they're not terribly interested in the customer knowing that their loan is owned. I think that varies. The utilities and some of the local partners very much want credit for having delivered a nice energy efficiency project and loan to consumers. So I think there's ways to move that around, those brand pieces around it, and let credit accrue where it's most useful. I'm going to go ahead and go on to the next slide. So this is a bit about the sale. I think the important pieces here are the size. Certainly the buyer, who Self-Help will talk in just a second. We only sold loans with on-bill, as I mentioned. We had a few others. We had to go through a contractual update with the participating utilities to make sure that everybody was on board with not only the sale, but the way that the loans were being serviced on bill. And that's because it was new, I think that strung out our process time-wise a little bit. And that was really the thing. I think doing the deal itself took about 3 months all in, maybe a little bit more. But then ironing out this new arrangement with the utilities took longer. And I think that's just to be expected. They generally move pretty slow, and they bring a good group of attorneys, which is often helpful. Self-Help had a little bit higher minimum credit score, but not much. We had a couple other items in there in terms of loans that had been delinquent, and they were happy to accept either way that we had done a security filing, as I mentioned, either the UCC or a deed of trust on loans that were a bit older. And then we have a loan loss reserve that we're carrying, and Self-Help can access that when a loan becomes 150 days past due. And then we have a back-end risk-sharing agreement for catastrophic losses, which we certainly don't expect. Next slide. To Allison.
Thanks, Adam. This was a really exciting opportunity for Self-Help to be able to partner with Craft 3, who we view as a really innovative CDFI that was trying a lot of different kinds of products in the energy efficiency space that we hadn't ventured into yet. And for us, this was an incredible opportunity to work with another partner to learn from their experiences, but also to build on experiences that Self-Help had prior to the recession on creating secondary markets for low and moderate income single-family mortgages. So prior to the recession, Self-Help had worked in conjunction with a couple of different national partners to try to create that secondary markets, and working with Craft 3 to create a different kind of secondary markets here for these energy efficiency loans that they were originating seemed like a great way to build off of both our CDFI's varied expertise. For us, it was also a chance to really push the envelope for self-help on our green lending products. As I mentioned earlier, we've extended a lot of loan investment to renewable energy producers as well as to commercial real estate projects that involve energy efficiency improvements, but we haven't yet done energy efficiency to residential homes as Craft 3 had ventured into. So it was a chance for us to push our green sector and to learn more through Craft 3. We were also really motivated from a mission standpoint in helping Craft 3 prove the efficacy of the on-bill repayment model. As Adam said, it's still young and there's still a lot of learnings to be done to figure out if on-bill repayment really does help enhance the performance of borrowers and help default prevention. But part of our involvement in helping creating this secondary markets for these loans was to try to prove that the on-bill repayment model did have some credit efficacy, and we're hoping that the performance data that we collect over time will continue to help to build the case. As I mentioned before, we are also interested in learning a lot more about how the characteristics of these energy efficiency loans perform, since they're not ones that we originate ourselves, but embrace the opportunity to be able to see over time how these loans perform. And as Adam mentioned, these are longer-term loans. They range from 15 to 20 years. We've owned the portfolio now for about a year, and 1 year is often a tricky time frame in the life of a 15 to 20-year loan, because you see some behavior, but it's still not a predictor of how things will be over that long term. But we're excited to continue to collect information and to see how things progress, and hopefully the next several years of the loan terms will be as good as the first year of owning these loans has been. We also wanted the opportunity through this purchase to encourage some activities that Craft 3 was trying to build on the ground in Oregon through this program. Adam didn't dive into it quite as much when he was describing the program, but not only was this an attempt to help make energy costs more affordable to residents of Oregon, but it was also done in a way where the improvements were trying to build a green workforce locally in Portland, and that was a workforce development piece of this that we really wanted to be supportive of. And then probably last but not least for us, there was some real strong capital deployment motivations in this sale. We had merged and acquired a couple of different credit unions in the last several years and had a significant amount of deposits that we wanted to put to good use, and didn't have the staffing capacity to build up that deployment quickly in direct lending. So instead we looked to find CDFI partners in the marketplace who we could help by leveraging our balance sheet strength to help them further their mission. So it was kind of a win-win for both Craft 3 and for self-help, because we were able to deploy capital and Craft 3 was able to recycle funds to continue to grow the program both in Oregon and in other areas. So next slide. Next slide, please. So I think as we step back and reflect and take this moment as the papers were being written and we were helping Lawrence Berkeley National Labs put the case study together, it was a chance to really think about lessons learned from this process. I think the first and foremost for both Craft 3 and self-help was the key that partnership, collaboration, and patience played in making this transaction possible and also successful. So Adam mentioned that this took a little over a year, most of 2013, to bring this transaction to fruition. And it involved not just the two of us, but also on-the-ground partners in Oregon and as well as the utilities. So with that mix of players that we had never dealt with before, it was really helpful to have the partnership and collaboration with Craft 3 to help answer the questions that self-help had about this product that we weren't familiar with, and also to navigate all of the different utility players that were at the table. And I would emphasize that that partnership and collaboration isn't just relegated to the underwriting and origination part of the transaction. It carries forward and is just as critical once the transaction has been closed. questions and the little bumps in the road that come up after we purchase the loans are much more readily navigable because of the great working relationship that we have with Craft 3. I think one of the big pieces post-transaction that's really important is the data and the processing between our two organizations. And I know that sounds like a real catch-all phrase, but it really is very critical to self-help from the perspective of an investing purchaser to ensure that all the information that we get from Craft 3 on a monthly basis that gives us updates about how the loan is, how each of the 1,200 loans that we purchased are performing, where they are in terms of payment on principal and interest, what their relationship is with utility still from an on-bill standpoint. Having all of that information come to us in a cohesive fashion that enables us as a regulated investing entity to be able to monitor the portfolio is really critical. And so that gets, again, to underscore the need for a really collaborative post-transaction relationship. I think one of the other things that both Craft 3 and Self-Help learned through the sale was in the absence of long-term performance data on unsecured loans, which is how we had to view these since they were often fairly subordinated liens to the real estate, to the homes, it was important to think about what the right credit enhancement tool would be between the two organizations. So as Adam mentioned, there's a loan loss reserve that Craft Self-Help can have access to, as well as some other risk mitigants. But we're hoping that over the course of time, we'll be able to document some of the performance data on these particular types of loans. As Self-Help was doing our underwriting of the purchase, there just wasn't a lot of real strong data available in comparable loan products. And I think at the bottom line, we're both open to doing more. And between our two organizations, and from Self-Help's perspective, we're also open to working with other organizations who are doing these kinds of loans. And Craft 3 probably hit some of the bumps with our own learning process, and hopefully Self-Help we've gone down a good learning road with Craft 3 and are looking forward to talking to others about their products as well. So next slide. So if you have any questions about the purchase or the transaction, this is Adam and my contact information, and we'll be happy to answer questions at the end of the webinar as well. So now I'm going to turn it over to Bert Hunter from the Connecticut CPACE program to talk about his details.
Hello, can you hear me? Hello.
Yep, we can hear you, Bert.
Yeah. Okay, great. Thank you, Allison. Thanks, Emily, for running the deck here. I'm delighted to be a part of this webinar, and just wanted to commend the Yale Center for the great work it does to keep various stakeholders abreast of so many key issues that are driving the markets for clean energy and sustainability, as well as our friends at C Action, which Bruce mentioned we're involved with and support their various activities. Next slide, please. So this is what we'll be going through during this part of the webinar, which is focusing on the Connecticut Green Bank and its work in driving energy efficiency and renewable energy upgrades for commercial, industrial, and multifamily properties here in Connecticut. So we'll give you some background, brief background on the Green Bank, some state energy context, a little bit about the CPACE program, and then we'll talk about our portfolio sale and what we're up to now and some lessons learned. Next slide, please. So the Connecticut Green Bank was created by Public Act 1180. It's the successor to the Connecticut Clean Energy Fund, and it marked the transition from rebates and incentives to clean energy finance in order to leverage public funds and in that way catalyze private capital into clean energy investments. So we focus on financing clean energy, not clean tech. So we define clean energy quite broadly here in Connecticut. It includes energy efficiency, solar PV, alternative fuel vehicles and infrastructure, and so forth. We have a balance sheet currently about $120 million, and roughly half of that is invested in financing programs. CPACE and our first and second solar lease programs comprise about half of that. And we're funded with a systems benefits charge that generates about $30 million a year, plus some RGGI funds. And if you want to find out more information, just go to that URL down at the bottom of the page there. And I'm sure these slides are going to be made available after we're done here. Next slide, please. So this is how we're organized by various market sectors. We have statutory infrastructure, which deals with grid-tied investments, such as our 15-megawatt Bridgeport fuel cell. It's got a wind project going up in Colebrook, which is 5 megawatts. Our residential sector, where we have our smart e-loans, does many things like what Craft 3 was just talking about. We have our solar lease, a solar loan product as well, which we currently are not offering because that graduated to the private sector, which we're quite proud of, our graduate solar loan that's operated by Sungage Financial. And we also have our multifamily efforts there. In the sector with a dot around it, dotted line, that's our commercial and industrial sector, which we do CPACE and microgrids and some other activities. And then we have our institutional sector, which is where we have our Lead by Example program that is in collaboration with the State Department of Energy and Environmental Protection, our MUSH activities, and you see on the left side, we're really grounded in state energy policy. The Integrated Resources Plan, Comprehensive Energy Strategy, both of those produced by DEEP, the utilities with their Conservation and Load Management Plan, and our own comprehensive plan of the Green Bank. So all these policy parameters are guiding us in what we do. And in my area, we bring in the financial part, we bring in the supply of capital, and the sectors deploy that across the various markets. Next slide, please. So here's the key challenges that are driving clean energy policy in Connecticut. We have the highest energy costs for electricity in the lower 48 states, and a very old and inefficient building stock that we are trying to make more efficient. And we have a need under policy for cleaner and cheaper energy sources to try to diversify our energy mix into renewable sources. And from the storms that I'm sure you all know about in the Northeast, we've got grid reliability issues. We've had outages that have lasted a considerable period of time, and so we're dealing with that as well. Next slide, please. So to kind of put a picture to the energy costs, this shows how energy costs line up across the United States with the exception of the Mid-Atlantic. Click, please. Thank you. There you should see the Mid-Atlantic takes quite a jump, and if you click one more time, you'll see that New England goes one step further, and then Connecticut beats them all. Something we're not happy about, but that's something we have to deal with. We have commercial rates that are just about 50% higher than the national average, and industrial rates that are about 85% higher. I mean, it's just these are staggering differences, and that really drive home the need to be more energy efficient and save energy consumption whenever you can. Next slide, please. And so this is where CPACE comes in. Most of you probably know how CPACE works. We'll dive into it just briefly. But it enables commercial and industrial properties as well as multifamily properties here in Connecticut and throughout the United States, actually, to access financing for energy upgrades and pay those back via the property tax bill. There is PACE as well for residential properties, and the Green Bank reported to the Connecticut legislature this year on our PACE and submitted draft legislation for our PACE. But so far we do not have our PACE, but depending upon the legislative process, Connecticut could have a statute in place at some point to enable our PACE here. So, but the key things to focus on as far as commercial PACE here in Connecticut is it provides this 100% upfront low cost, around 5 to 6% right now for up to 20 years for financing your energy upgrades. It really does help the energy improvements to be cash flow positive. In fact, our statute requires us to be cash flow positive, and we'll talk about that shortly. The owner repays it through the property tax bill, and the PACE lien in Connecticut and in most other states, there might be one or two exceptions, is senior to mortgage indebtedness, and in our case, it's senior to everything except local property taxes. Next slide, please. So this is the Public Act 12-2, the main key points from that statute that gave the Green Bank the authority. In fact, I'm going to start at the bottom and work my way up. I really think that the bottom is the most important because it really gave the Green Bank the authority to administer a statewide program. This does a lot of things. For one thing, it makes it very clear how the program should be run, and it focuses on one set of guidelines, but it is a totally open market, meaning that capital providers can come in, contractors can access the market, property owners can access the market. So although we administer it, it's open to all. The next to the last point, the municipalities have to opt in order to play in CPACE, and so they have to pass some statutes at the local level. The next point going in reverse order, it requires cash flow positive to be demonstrated. That SIR, the savings to investment ratio, has to be greater than 1, and that's confirmed by an outside consulting firm we'll talk about very briefly. And it has to be permanently affixed. So the lien stays with the property, the obligation to pay stays on the property, and so must the improvements. And the second dot on the page there, it requires the consent of the existing mortgage lender. This is part of our statutory requirement. We have to talk to the lender that is on the property right now, but since it is a non-accelerating lien, and when we enforce the lien due to non-payment, or if we assign the lien and whoever is the lien holder forecloses on the property, they can only foreclose on what is due or past due. They cannot accelerate the total obligation to the present time. And it's for commercial, industrial, and multifamily property. Next slide, please. So if you're really interested in how PACE works, I would ask you to kind of consider this slide. But generally, what happens is the property owner works with a contractor. They apply to us. We review it for whether it conforms with SIR and financial underwriting considerations. And assuming that is all clear, you go to the second level where you get your project done. We provide the money out of our funding warehouse. And in the third section down at the bottom there, the project is complete. The property owner starts to pay the obligation back through the property tax bill, and we monitor energy savings for at least 5 years thereafter. Next slide, please. So to give you a sense of how much progress to date we've had, and their progress has been considerable, we are in 105 cities across Connecticut. There are 169 cities in total, but we have 85% of the market, so we've got the biggest markets covered. More than 100 companies trained. A third of those have approved projects. And we have great success with our mortgage lenders. It says 25 mortgage lenders have provided consent. We're actually up to 30. And we've done $70 million worth of projects. We're the most successful commercial PACE program in the nation. 90 plus projects have been approved. 10 megawatts of solar PV, which is just incredible, just really bringing solar PV to properties that otherwise wouldn't have it. And we sold $30 million of these projects off in a securitization to Clean Fund, and we'll talk about that very shortly. So next slide, please. Here's one of our PACE setters, Peter Corbett of InSports. He installed energy-efficient lighting in a 252 kilowatt solar PV system, and invested $1 million, and Peter is going to save his in-sports facility $1.8 million over the term. Next slide, please. So at the present time, the Green Bank, as I said, is funding all of these projects from our $40 million warehouse facility, and that's part of the $120 million balance sheet I referenced earlier. But with projects coming to our website daily, we need to sell off the completed projects to investors to replenish the warehouse facility. Next slide, please. And this is how we did it. Back in the summer of 2013, we organized a portfolio sale. This is the initial portfolio with 11 projects, $8 million. Next slide, please. We had to organize the underwriting. If you go to the next slide, please. We organized the underwriting process by giving an offering notice, laying out the objectives of the sale, instructions on how to submit bids on this portfolio, and the schedule for accepting bids, evaluating the proposals. Next slide, please. And closing the transaction with the accepted bidder. We also wanted to be sure that we made the bidders aware of risks associated with these investments. They're unlisted, they're not liquid, property owners may not pay, and so forth. And we gave them access to a data management platform with complete information about all the projects. You can see the login page there. Next slide, please. And when you get into that information in that database, they would find a tear sheet, as we call it, summarizes the key details of the project, property owner, location, the assessment, meaning the actual financing amount, the savings investment ratio, debt service coverage ratio, lien to value, loan to value, all these metrics that we use to underwrite the property. Next slide, please. And here's a summary report of energy savings produced by SRS. This is where we determine the SIR. Next slide, please. I'll mention that that SIR report is quite lengthy, so this is just a summary. And in the end, the bidders had to submit their proposals to us in a way we could standardize the proposal across all properties. Well, seems like PowerPoint's restarting here.
Yep, sorry about that.
That's okay. I'll wait for you to get back. I think we're on slide 21. Oh, I don't know which, 21 of mine, but not sure where that is in the deck there. There we go. Keep going, please. I think we're down 2 more. And there we go. And so this is the result of that whole process. We selected Clean Fund, and how we decided to structure this deal was as a securitization. So we put all these benefit assessments in a pool. We established an indenture that is a trustee is responsible for managing the cash flows that come in. We have a servicer that collects the cash, but the trustee is officially responsible for getting the cash once it's in the accounts to the appropriate investors in this case, Clean Fund as well as the Green Bank. Clean Fund has the senior Class A bonds representing 80% or $24 million in asset value, and the Green Bank retained the junior Class B and C bonds 10% each for a combined $6 million in asset value. So we stayed in the transaction to credit and enhance it. And by doing that, we were able to sell the portfolio at a higher yield. So all these transactions averaged a yield of about 540 and change, and we sold at about 595. So we suffered a loss on the sale of the 80% of about 4%. But keep in mind, we didn't really know where the market was when we started this whole process. So we considered that a bit of a victory to just have a slight discount for the initial tranche, and we're much closer to par right now since our portfolio yields have gone up. So we're in good shape. Next slide, please, or next, you click once. And the transaction was a, quote, watershed deal. Not my words, but the words of Green Tech Media, so we're quite happy with the results. You can look at that on Green Tech Media's website if you like. Next slide, please. So here we look at a progression of our progress, and you can see in the latest 6 to 7 months we have approved transactions at a rate of 3 times what we saw in the first year of the program. We think that more contractors, particularly PV contractors, are recognizing that they can use 20-year 6% financing to drive a ton of business with commercial properties that before have been locked out of the market due to the inability to finance these improvements. Next slide, please. So to cope with this growth, we have established a standard offers. Next slide. And that is to invite private capital to partner with us. We will work with private capital and credit enhance their projects to a degree, try to encourage them into the marketplace. Next slide, please. And we're also making, let's see, keep going, one more. There we go. We're also making great progress with an RFP for private capital solutions. We need a private warehouse. We just don't have enough capacity on our Green Bank balance sheet. Large as it is, we're not 100% dedicated to CPACE, so we have to provide capital to other programs. So that's going quite well, and we have received a number of proposals for financing facilities of from 50 to 200 million. Next slide, please. And I'm just going to gloss over these. This is the selection criteria. You can look at that when you get these slides, but it's just how we intend to evaluate the proposals. Next slide, please. And you can actually skip over that one. And we'll get to some of the lessons learned. So the key lesson we learned is private capital, thankfully, likes this asset class, so we were able to move these investments. And judging from the response we've had from our RFP, there's a considerable interest now in this asset class. So the Green Bank is actually succeeding at crowding in funds by taking early risk and aggregating. But at the same time, to be successful here, we think you really have to think holistically and strategically, as we say, because there are just a lot of moving parts in this puzzle called energy efficiency finance. Selling a portfolio in advance was a big challenge for us. It's going to be a little bit easier now, that a considerable portfolio of transactions that we're moving in the market. So we've demonstrated that we can originate these transactions and that there is a marketplace that is really ready to scale up this market in energy efficiency. We also learned that pricing isn't everything. I think that's a key lesson. Transaction friction can kill a deal. It's more important, I think, in the end, to have partners that you can work with and to realize that this is a market that's dynamic and it's evolving. We've got many different lenders and investors coming in. The ratings methodology is evolving for when we hope to be a part of a rated transaction in securitization. And there's a constant feedback loop. Everyone's getting smarter and better at this, and we think we're part of it and doing our bit to prove that this can work and be successful. So that's the end of the presentation. Next slide, we'll have my contact details. I'm happy to talk to any of you about this anymore after the presentation, or take questions later. Thanks.
Okay, I think We'll go to the, this is John Byrne, and I'm with the Foundation for Renewable Energy and Environment, a 501c3 created to develop programs that particularly involve structured financing, and I will go over a couple of cases in Delaware and Pennsylvania. Very thankful to Emily and Michael Bruce, the Sea Action Network and Yale Center for Business and the Environment for this opportunity. Next slide, please. I'm going to cover the use of the bond market for financing. That's already been covered with a bit with Bert's presentation, but I'm going to focus on a different segment of that market. So I thought I would begin with why one would look to this market, and there are several reasons. I thought I would just call out a few. Cost, debt financing through the bond market is almost always going to be the cheapest option if you can put it all together. It certainly has sophisticated investors that know how to analyze products and can certainly provide in this way a substantial, we have not found any difficulty in terms of size or scale for this kind of activity. So we think the market is a really excellent market for the focus that we have, which is really in that second bullet about community governance, trying to give both the geographical communities, cities, counties, states, the opportunity to make choices about the underlying infrastructure in the public sphere, and then also those communities defined by function or even virtual communities that want to, for example, hospital groups or university groups that want to specify goals for themselves and then want to finance the realization of those goals in a cost-effective manner. So that's really been our focus. As you can see, these are the indicative borrowing rates from a program we're now offering in Pennsylvania. It's our approach is a pooled financing that involves a serialized structure, so you can see what our borrowing rates are for the first year of say a 15-year borrowing, and then you can see the 5th and the 10th year, and you could look at an A-rated and see that it's really very handsome in terms of borrowing rates. The other thing that really compelled us here, I've used the notion of grandchildren. I'm a grandparent. Grandchildren mean a lot these days. We have a significant problem that we need to resolve. Best estimates out there is that we need to cut fossil fuel use by more than 50% in the next 20 years. And to do that, we have to go much faster and try and find ways to give people choices that go beyond what is currently provided in the more incremental elements of policy on this issue. So those are three reasons why we felt that the bond market was a really good idea. But there are also problems with going to the bond market. Next question. Next slide. This is a sophisticated market, but it also means that you've got a great deal of expertise you need to pull together to make this work. And another key challenge is that there's a great deal of documentation that's required in order for you to go to the market, from early on letters of interest all the way through different kinds of investment-grade audits that might be performed, guaranteed savings agreements, monitoring and verification. A related problem is that the financing itself, in order to structure this, particularly to involve several participants, is complex. And this is our simple graph of a bond financing. You can see if you're the participant in that red box down there, you'll be signing up for a guaranteed savings agreement that is going to pledge a rate of savings, I'll get into this, that will be greater than the financing. You're going to use your own appropriation source as a way to pledge payment to the issuer of the bond. There'll be a program agreement that will govern all of the moving parts of all of this, and then you're off to trustees and bondholders, and it's it's quite difficult as an approach, but it has, as I'll show you in a moment, some great dividends. For some, over time, ESCO has become a four-letter word. Energy service companies try to balance many, many things, and I think it is not an easy task that the sector has, but there is pushback, particularly in the public and nonprofit sector. As I will try to show you, we try to address that problem in a particular way. And the last part that I think is very important, this is a process that will take 6 to 8 months to go to market. There are a lot of steps and a lot of moving parts, and sometimes participants, particularly moderate scale cities and counties, school districts, I'll get into all of this in a moment, can find themselves sort of overwhelmed by the process. So that's one of, I think, the reasons that we need to think about how better to do this kind of financing opportunity. I'm going to try and address ways in which we at least have felt that we could overcome a number of the problems that are presented here on this slide. Let me go to the next slide now. When it works, and we were able to do this in the case of the Delaware Sustainable Energy Utility, also a 501c3 that I helped develop and co-chaired the board through this financing that I'm about now to briefly indicate to you. We were able to sell a bond issuance involving 8 participants, 6 public agencies and 2 nonprofits, and we involved 6 contracting companies. Many of these companies are well known, I'm sure, to a number of you, from Johnson Controls and Noresco to Trane and Ameresco, Honeywell. So we put together this this investment. We were fortunate to go to the market and sell our first ever issuance of debt for this purpose with premiums. We purposely designed the program to have a long payback period. We went after the deep retrofit, not simply the sort of early paybacks in lighting and motors and controls and that kind of thing. So we were out as an average payback of 14 years. The bond itself was a 20-year series. Our effective borrowing rate was just about 3.7% over that entire issuance. The bond was sold back in 2011, and you now have both construction period performance and post-construction performance, and both in the period of construction and afterwards, in every case, for all 8 participants, the performance has exceeded the guarantee. So the result of all of this has been a very good thing for the participants in Delaware. The Delaware SCU, Sustainable Energy Utility, is very happy with this model and was able to, I should mention, was able to do all of this without any contribution by the SCU into the deal itself. That is the pledge of payment by appropriation and the backing that was there from the guarantees, the guaranteed savings agreements, was sufficient for this particular financing to take place. If we go to the next slide, the overall results of this particular transaction at the Delaware level, there is a pledge of payment, if necessary, from the energy service companies of up to $148 million. The all-in cost, including all debt service, transaction costs, monitoring and verification costs, and so on, all of that in is $110 million, creating a surplus of about $38 million on the deal. This involved only 4% of the floor area of the public sector in the state of Delaware. If you were to apply this similar percentage at the national level, this is not for federal, this is non-federal properties. This is a financing that would be on the scale of $25 billion. And I bring that up because this is, since it's only 4% of floor area, this is something that, if it was done properly, is something that could be done on a regular basis, and these kinds of savings and job creation could be part of an ongoing process. A last step that I'd like to just mention in terms of the benefits that come from this kind of approach, the savings that we're talking about are not estimated savings that sometimes occur in different rebate programs, for example. These are monitored throughout the term of the debt, and so a monitoring and verification process is there to make sure that the savings are actualized. I'll get into what happens to cure it. We have an improved program in Pennsylvania that I'd like to focus on for that purpose in just a moment. Again, it did not require ratepayer or taxpayer support for this to occur. This was a self-financing approach, and in this sense represents, I think, a companion to what you've already heard on the panel today of ways to go about and hopefully speeding up the process of investment in sustainable energy. So that's the Delaware deal, and on the strength of that deal, next slide please, we organized a new set of programs in other states in the U.S., and the one that I'm going to just briefly go through is our Sustainable Energy Finance Program in Pennsylvania, which is offered with the Pennsylvania Treasury. The Treasury is an investor in the program and is helping us to market the program. The key things that we learned from the Delaware deal to try and do this better are to make sure that there's a very careful pre-qualification of companies so that they can meet the stiff standards of a guaranteed savings agreement that we require. The guaranteed savings agreement spells out the monitoring and verification plan in great detail, and because of the way that we create this guarantee, the cure is on the side of the companies. They must either deliver the dollar savings that are pledged in the agreement, or they must cure by installation of additional equipment on their own dime, or working with the entities to make sure that a better use of the building, for example, management improvements that could make that occur. We guarantee only the energy and water savings, so that operational savings, deferred maintenance, and so on are a bonus. That is, we've created a program where the guarantee, in terms of its actual impact on the participant, is conservative. We provide a trusted advisor function. The free team has legal, financial, technical, energy specialists that work throughout the negotiations of the deal, and we offer a post-construction support up to 3 years. So these were some of the important things that we learned. Standardizing the documentation also, it was critical in Delaware, and I think we've done an even better job since then, and particularly in Pennsylvania now I think we have a very good set of documents. And if you want to see the documents, you can see at the bottom of the slide where the website is. All of the documentation is there if you'd like to take a look. A second major lesson was, in the next slide, was to widen the participant base. In the case of Delaware, we dealt with mainly state agencies. It's become quite clear, working in other jurisdictions, that we need to widen who can participate in this, and that also means that we have to have the kind of expertise needed for the different kinds of entities to participate. So this is the range of participants that we are now marketing to in Pennsylvania. Next slide, please. We also make sure that we can customize the measures for the individual participant. That is a really key factor. There is no one-size-fits-all. I think many of you know that a couple of measures, such as lighting, have often been used as the basis for these kinds of financings, but it typically is the case that these public and nonprofit participants are really looking for a series of measures that can be implemented, and through that implementation process, that a more comprehensive approach to their energy requirements can be had. So we basically include all of the standard conservation measures, but we also include distributed generation on site. We have worked in a variety of different renewable energy sources, including solar. We have also worked on a variety of options. We're currently looking at a microgrid in one of our project opportunities, and all of this with the key requirement that whatever the investment is, that it can create a stream of energy and water bill savings sufficient to fully finance the investment. Finally, a major thing that we learned out of all of this, next slide please, monitoring and verification. A lot of times, unless you are talking about a large entity that has staff on hand to be able to handle this, M&V can kind of be part of that participant in headlight syndrome. Folks don't find it easy to understand or to utilize to their own benefit. So we have done two things here. First of all, the monitoring and verification process that's in our documentation is diagnostic. It provides advance indication to both the participant and the company that has signed the guaranteed savings agreement whether the guarantee is going to be met, and it provides the basis for cures to then be developed over the course of the year in order to assure that the guarantee is met. Rather than arguing over fine details of how to measure building performance and so on, we have removed that particular problem in the past with M&V. Instead, the program itself sets a schedule of energy and water prices over the 20-year period. The program, through the advice of the free team, sets it conservatively, and that price vector is then multiplied by the physical unit savings that are provided by the participating contractors, and that then defines for each and every year what the dollar savings must be. And the question now is only how can we make sure that we meet that most cost effectively. We use all the standard M&V protocol, but I want to emphasize that the approach that we take here essentially removes what has been past practice of arguing over finer details on methodology, and instead simply diagnoses what needs to be done. Because the free team is there as part of both the negotiation process and the post-construction process, we are able to turn this particular item away from what has been a not necessarily positive experience for some. We've now been able to turn this into a step that actually is a positive part of a transaction of this kind. The next two slides, my final two slides, just briefly go through the process by which one participates in a program like this. This is the PENSEF particular 8-step process. We obtain a letter of interest from participants, and we gather a sufficient number of letters to then produce education days. Because Pennsylvania is a large state, we do these educational efforts in multiple locations where we go through the financing in detail, and the participants can ask questions, and then we break down and work with them afterwards on how to get a project development process started for them. We assist them throughout all of the steps. We help them to get the kind of data that will be needed for a pre-contract audit that we offer in the process. This is no cost to the participant, and we have a fairly seamless way in which billing and other kinds of data that's needed come to the ESCOs that are pre-qualified, and we then use that pre-contract audit to give participants an idea of what kind of project or projects they might want to think about. If they, next slide please, if they like the what they see, we move to a next step, which is to then have an investment grade audit done. The investment grade audit must deliver at least 90% of the savings identified in the pre-contract audit. This is to prevent gaming of participants in this particular process. We then move with the participants through that IGA, the investment grade audit. If they find enough in there that they want to develop into what we call a project, we then begin to package that project into a guaranteed savings agreement. Again, the documentation is all standardized. All participants, all participating companies use the same documents for this purpose. And we back in that guaranteed savings agreement with a detailed monitoring and verification plan. Next step is then for the participant to accept the proposal, spells out the guarantee, they get to indicate, they get to choose, and we customize, we give them different analytics on options they might have so that they can look at what their debt payments against savings would look like, and if they want to front end stuff, they can do that. If they want to back end, we can do that. If they want levelized debt service, we can do that. At that point, we then move to the performance of the retrofit work. This does include on-site generation. We have done renewable energy projects as part of this as well. And then, as I mentioned, we then stay with the process after construction to make sure that the monitoring and verification plans actually show to the satisfaction of the participants that they are realizing the dollar savings, not simply physical unit savings that they had anticipated. And that's really the basics of the program. I've included, I just mentioned, I've included, I won't go into them, but some additional information on a new effort that we're working on, which is to now create what we regard as Solar City platforms in which investment, for example, in solar technology can take place on a citywide basis, and we've just completed an analysis for 6 cities, New York, London, Amsterdam, Munich, Tokyo, and Seoul, to show how you can combine policy, technology, financing. We did all of this as bond financing. And so I think there's a lot of exciting opportunities coming up on this kind of scale, and I just wanted to let you know about that particular item. And I think that's all that I have. I'm trying to go quickly so that we don't chew up the entire time of the webinar for presentations. Thank you very much.
Hi, this is Emily, and I'm hoping that you can hear me. I know that the Yale team, who's going to be moderating our Q&A, has been having some technical difficulties. So Yale, if you can hear me, we actually can't hear you.
Hi, Emily. Can you hear me now?
Emily, I can. This is Bert Hunter. I can hear you.
Emily, can you hear me now?
Yes, there you are, Michael.
Okay, good. Second time
we've
today
got
I've
you
talked to myself. Okay, so we've had some good questions from the audience. I'll start off with Adam and Allison. We've had a few questions from Patrick and Carol and a couple of others, really about what's in it for the utilities to participate in on-bill financing. Are they incentivized? Are they charged a fee? And if not, how would being charged or charging a fee for that process affect the economics of on-bill financing?
So I'll take that quickly. This is Adam. We do pay the utilities a monthly fee. Craft 3 pays the utilities a monthly fee for the cost of providing on-bill servicing, and it's quite low. We've been recently talking with them about what they should be charging, and it's a good, healthy negotiation. And I think they believe that this has been a benefit to their customers. They see happy customers, and so they're working with us on the fee. Interestingly, in Oregon, on-bill repayment is by the IOUs is more or less required by law, by state law. So when we started this, the utilities were compelled to have a conversation with ourselves, the Oregon Department of Energy, and the Energy Trust of Oregon, which is a strong partner in this and has been helping the conversations with the utilities from the beginning and now plays a more integral role in terms of contracting. I would say, though, that in the last 6 months, conversations between Craft 3, Energy Trust, and the participating utilities have turned more to a voluntary perspective. So we are now talking with them about expanding on-bill lending programs to their customers, and they are coming to us and asking us to help them develop that feature, both us and at the Energy Trust of Oregon. So that has been very interesting. I think that is proof that they view this as a positive feature.
Great, that makes a lot of sense. Okay, so the next question is from Roger, and it's for Bert. And the question is really around the role that CPACE, specifically for solar, plays, and how it competes with other private developers like Solar City. Do you see these two financing mechanisms as complementing each other or really in competition?
Thanks for the question. I see them as totally complementary. Excuse me. And the reason is because it really comes to the property owner's preference. If they want to own the system themselves and take the tax credits and depreciation, they're able to monetize those tax credits and depreciation, then and they are able to do so through a financing of the PV system. On the other hand, if they want to work with Solar City or any other third-party owner, we can secure, and we have made many presentations on this, we can secure the repayment of the PPA through the CPACE mechanism. So we're able to do both. So we see them as perfectly complementary, and that innovation that we pioneered here has actually been adopted in California, I believe, as of January 1.
Great, thanks, Bert. Okay, the next question is for John, and it comes from James. With the Guaranteed Savings Agreement, how are changes in personnel and weather impacts adjusted for in the savings results analysis?
Yeah, thank you. That's a very good question. The Guaranteed Savings Agreement has within it an ability to adjust, for example, on the baseline if the change in personnel or a change in function of a facility occurs, then there is a process that's spelled out in the GISA of how to redefine the baseline for that purpose. At the end of the day, the financing must still generate savings that are greater than the cost of financing. And so that baseline adjustment is part of a process of trying to recognize what can happen over time, and but to do so in such a way that you retain the requirement of the savings in effect being greater than the payment that the participant must make to the bondholders.
Great. Okay, so we've got another couple of questions for Adam and Alison. These come from Steve and Carol, really around how you would go about setting up an on-bill financing program in a new jurisdiction or with a new utility. What approach would you take? What sort of conditions need to be in place for that to be successful?
Well, I would first of all say that our organization, Craft 3, we're a finance institution, and we speak sort of a novice utility speak. We have been very lucky in Oregon, especially to have the Energy Trust of Oregon, which is an organization that was created by state law to work with utilities on conservation and renewable energy, to work with the utilities and us to set up a number of these programs. So from our perspective as a loan originator, I think it's really important to excuse me, I'm sorry. It's very important as a loan originator to have a partner that works in utility land and can help translate some of the more complex questions about regulations. So I would look for someone at the State Department of Energy in the states that you work, or if you're lucky enough to have one of the third-party organizations in states like Vermont and Wisconsin, that would be very helpful. Other than that, I think it's about crafting agreements that are very clear in terms of risk mitigation and protection for the utilities. So our agreements with the utilities and Energy Trust spell out very carefully what we do with their customers and what they are not obligated to worry about when in terms of loan losses. And I think that's a huge piece, or defaults, or delinquencies. That's a huge piece of what we do, because ultimately they just want to process the payments and deliver their customers a service.
Okay, thanks for that. Okay, so the next question is from Steve for John. And he asks how Delaware's SEU projects have actually performed so far. And he was wondering specifically if ESCOs have been forced to step in financially to meet projected financial performance in any cases. So, John, did you get that question? Okay, looks like we may have lost John. We'll move on to the next question.
Oh no, I'm sorry. Hi, here I am. I'm sorry. I muted and didn't unmute.
That's all right. I know how that feels.
So quickly, yeah, on the Delaware Sustainable Energy Utility website, Energize Delaware, you can find the latest report on performance. So you can see what did happen. No ESCO at this point has been under guarantee. All individual projects and all projects together are over the guarantee. So and our experience working elsewhere, we have looked at these programs and offered these programs in other jurisdictions. It is certainly the rare event that the ESCO fails to meet the obligation, partly because the way in which we structure the financing, the estimation that's coming in is conservative against what will be actual performance. And so I think so far so good. On the broader points, the Delaware SEU offers not only the bond financing, but other approaches where, for example, loans where there is some cases that there can be some failing on that side, but for the most part, I think these programs, as I think all of my colleagues on the panel have indicated, these are very high performing, very high percentage, and that's part of the reason why the market likes them.
Great, thanks for that. Okay, so we'll do two really quick last questions because we are out of time. Firstly, Melissa asks both either Adam or Alison, how property sales are handled. Do property owners have to pay for the remaining loan balance in full prior to sale, or does it transfer with the property?
Sorry, Alison, I'll just take that one again because we deal with that daily. So we subordinate for refinances in most cases. When the property is sold, we have a note on title in terms of the UCC, so we look to the owner to pay off. If they don't pay off or cannot pay off, or it's a hardship of some sort, we work with them. And like I said, I think earlier, we have a small percentage of our portfolio that is serviced via ACH and not on bill. In some cases, those are folks who had to sell it and under a hardship scenario. But in most cases, they are paying us off at sale, or we simply won't clear our UCC or deed of trust off the title, and that messes up the transaction, presuming it's not a cash transaction.
And this is Allison. I think what's been interesting for us to see over the last year, perhaps an obvious piece, but the shifts in this book have really trended with the overall residential markets, and so we've seen a lot of prepayments actually happening as homeowners have been able to refinance fairly quickly. So for us, it'll be interesting to see with the book that remains how that continues to perform since we had such a high rate of prepayment at the beginning of this.
Great, thanks, guys. So we are out of time. This is going to be the last question, but thank you, everyone, for giving us so many good questions. So this one comes from Sky and John, and it's for John. And they were both wondering a little bit more detail about the free process, so the post-construction advisory service, what exactly that service entails.
Right. So when construction concludes, sometimes participants can find themselves still a bit in difficulty on understanding what their legal rights are and how to make sure that the contracting is going as they wish, to make sure that the financing is performing as they had intended, or if they want to now seek some restructuring of how to do that, and then finally to make sure that the performance of the equipment and of the management strategies, the distributed generation, and so on, are doing their job properly. And in that vein, the free team offers a multidimensional team that can come in and help on all three fronts: legal, financial, and energy/technology. It is a small fee that is, if it's at the choice of the participant, but it can be included in the proceeds of the financing and paid off that way, or there can be a separate consultancy that's set up for that purpose. So far, folks like to just put it in the proceeds of the financing.
Great, thanks for that. So that is all the time we have for today. I'd like to thank Bruce, Bert, John, Adam, and Allison for a really great presentation. We covered a lot of ground and had a lot of great questions from the audience, so I'd like to thank everyone for listening in and being part of the presentation. I'd like to remind everyone that today's talk will be made available online through the Yale Center for Business and the Environment website and our iTunes U page. We hope you'll join us for the next Blueprint for Efficiency webinar in a week's time. It'll be co-hosted with the Council for Development Finance Authorities, the CDFA, and we'll be looking at accessing creative revenue sources for energy efficiency. This is Michael Puckett from the Yale Center for Business and the Environment, saying so long from New Haven, Connecticut.